Net Wealth Investments Limited is licensed to provide general advice. Our podcasts are not tailored to any one financial situation and may contain views of our presenters which may not align with Net Wealth's. The guests' organisation and Net Wealth have an arrangement for their financial products to be available for investment through the Net Wealth platforms, and Net Wealth may receive fees from the guest. More information about Net Wealth can be found on our website, including our financial services guide and disclosure documents. Please seek professional advice before acting.
Welcome to the Net Wealth Portfolio Construction Podcast, brought to you by the Net Wealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the Net Wealth Investment Podcast series. My name is Paul O'Connor and I'm the Head of Investment Management and Research. Today we have Matt Sherwood from Perpetual Investment Management, who is the Head of Investment Strategy, Multi-Asset Strategies. Perpetual is an ASX-listed diversified financial services company that was established in 1886. Perpetual consists of three core business units: Perpetual Investments, Perpetual Private, and Perpetual Corporate Trust. The Perpetual Investments division manages approximately $27.5 billion in funds under management as of March last year. Perpetual offer a broad range of products for both personal investment, superannuation and retirement to individuals, financial advisors and institutions across Australian and global shares, multi-asset investments, credit and fixed income, and Trillium that offer ESG investment strategies. There are 14 Perpetual managed funds currently available on the Netwealth Super and IDPS investment menus, in addition to their ASX-listed investment companies. Matt joined Perpetual in 2005 and he has regularly appeared on Reuters, CNN and Bloomberg in Asia and Sky News, SBS and ABC in Australia, providing his viewpoints and analysis of international developments. His opinions have been included in many newspapers, including the Wall Street Journal, Washington Post, the New York Times and Australian Financial Review. Matt is a published author of the book titled Intelligent Investing and began his career as a senior economist at the Reserve Bank of Australia. He has a Bachelor of Business from the University of Newcastle and a Master's degree in Economics, covering finance and econometrics from the University of Sydney. Matt has also held lecturing positions with Kaplan Education, formerly Finzia, between 1997 and 2010, and has also lectured MBA classes from Case Western Reserve University in the United States. Given Matt's background and role, I thought we'd focus today on the global macro economy and particularly the responses by central banks and governments to COVID-19 and the subsequent economic downturn. Good afternoon, Matt, and thanks for joining us on the podcast.
Hi, Paul. It's good to be with you and thanks for having me.
When it became clear in early 2020 that COVID-19 would have a significant impact on the global economy, the monetary response by central banks has been extraordinary via both conventional and unconventional monetary policies. The fiscal response by governments, however, has been slower, and numerous central bank heads have commented that stimulatory fiscal policy is also required to complement the monetary policies. So I'll certainly be interested in Matt's thoughts on this issue. For starters, Matt, what have been the major challenges for Perpetual post the COVID-19 outbreak? And did the business adapt to, everyone working from home for a period?
Well, it was quite interesting just chatting with our industry peers about, how the technology was rolled out. So we worked from home in the multi-asset team kind of towards the end of February, and it actually went pretty smoothly. So we're holding 2 or 3 4 meetings a week, particularly when markets are plunging. The technology was terrific. Fortunately, we've done a major IT upgrade across all of Perpetual in the prior 2 years. So that obviously meant that we didn't have any IT issues, we didn't have any meeting issues. Things like Microsoft Teams were incredibly handy. That and Zoom. So it's actually gone very well. And of course, what that means is that our time isn't swapped up on technological issues. We're focused on managing the client's portfolio, protecting capital as best we can during the sell-off, and of course, growing the capital when things turned a little more normal. But obviously, a once-in-a-century pandemic doesn't always go smoothly. But the issues have been pretty minor on that front.
Yeah, it's interesting, I guess, the way I see it. It's sort of COVID-19 has certainly induced a evolutionary change in workplace behaviour. I don't think it's
Mm.
revolutionary, and I think it's more to the fact that we've all really gravitated towards the tools that are at our disposal. And obviously tools like what we're currently recording this podcast on Microsoft Teams, I had hardly used prior to the start of this year, whereas it's a daily core form of communication for me and the investment team at NetWealth there. So it's certainly been an interesting period to work through in terms of those changes.
Yeah, look, I think some of the interesting things I've read about technology is the level of technological innovation and adaptation this year has been 10 times what it normally is. So we virtually had a decade of adaptation in the space of 12 months. So,
Mm,
and of course, they have all kind of consequences for workplace, work relations, where we do business, how we do business. And obviously, this is a rapidly changing situation, and we may just be at the tip of the iceberg for what are the long-term consequences of COVID, both positive and negative.
mm, mm. No, it is. It's been amazing the way
Mm.
that we've all adapted with the changing challenges that we've all had to face. The RBA responded quickly to the economic downturn earlier this year by lowering interest rates and commencing non-conventional monetary policy through our very own quantitative easing program. What are your views, Matt, on the RBA's response? And do you think the federal government's fiscal policy response has been appropriate?
Um, well, I'll take the federal government. I think the federal government did very well, as did most governments around the world, in the sense that we were faced in once in a century pandemic. We had the mid-year estimate for fiscal policy by the Morrison government late last year, and they were talking about budget surpluses. And probably there have been two key surprises on the government front. The first of all, how quickly the government changed from running surpluses to turn into radically the spender and the employer of last resort in the Australian economy as the pandemic forced economic closures. And they did this even though those spending programs like JobKeeper will produce absolutely zero economic bounty at the end. And that was one of the big surprises, how quickly they changed their modus operandi. Probably the second one on the fiscal policy surprise, I would argue, is it's funny that borrowers now are virtually willing to accept almost zero nominal interest rates in compensation to lending to massively indebted nations. That probably was another surprise there. But I think the government response was quite comprehensive. I think they realised the problem of trying to keep the labour market together, and of course trying to bail businesses out so you didn't get a negative left tail event from corporate defaults and businesses shutting down. So overall I think it's been very good. So they've won the war, and the challenge now is they have to design policies to win the peace, and that is, how do you get unemployment down? So whilst official unemployment in Australia is around 7%, I tend to think the real unemployment rate's over 9%. And so we're going to have several years of fairly aggressive fiscal policy to give the economy all the support that we can to find jobs for those displaced workers. For central banks also, I think 2020 has been, I think they would see it as a year of success. Given the fact that we had to close the economy down virtually bar essential services. There was massive displacement of workers, and there was risk that the financial system could implode, given the amount of bankruptcies there would have been or could have been. So I think I would certainly rate central banks very highly this year. But when I look at central banks for the last 40 years, I don't think they've been particularly successful outside of achieving low inflation, because central banks changed their modus operandi 40 years ago to why do they exist? Well, virtually to avoid recession. And by doing that, what they've done is traded inflation targeting against financial stability. So the world now is massively more indebted. It's more and more unstable. And of course, interest rates are now at zero. I think they've created or been part of a creation of, a massive leverage boom, which is unpredictable and which is obviously can be exposed to shocks like they were in 2020. What that means is policy then is going to become even more unconventional. So I'm not sure the system's any more stable, despite the fact that we have low inflation. So to me, I don't rate them highly over the last 4 decades, but certainly in 2020, they saw the problem, they diagnosed it correctly, they did the policy response, which was rates to zero, QE, but also loans to business, direct loans. So I think they've done very well this year to really reduce what could have been a mother of all crises.
Yeah, it is. It's interesting the way, I guess, monetary policy to a degree has worked in terms of it's pushed a lot of investors up the
Yep.
risk curve, and probably has been one of the key underpinnings of equity valuations and why they have not dropped like we've thought. But do you think the sort of second stage of the fiscal response will be more targeted around infrastructure and those types of areas of expenditure to try and work on that unemployment rate and bring that down?
I'm certainly thinking infrastructure spending will be part of it, and the government announced that in the recent budget. There was an increase in infrastructure spending. I think probably a more important issue is keeping household cash flows strong. So the more you spend, of course, the more employment you can actually create through multiplier effects in the economy. So I don't think the budget's going to have a one-dimensional solution to how do we get unemployment down, but it would include all the usual suspects of lower taxes, increased spending for stressed areas, and also trying to provide some industry assistance. For example, industries like tourism, which are going to be, the impairment there is going to be of a longer duration. The economy is not opening up to international travel for a while yet. Obviously, the vaccine's got to be implemented. It's got to be successful. So there are some industries which are going to, have a much longer adjustment process. So fiscal policy will be also targeted at not only helping those industries, but also keeping people's skills up and so on. So it's certainly not a 12-month problem the government has. I would argue it's kind of like a 3-year program they need, and they certainly have initiated this in the budget to provide the economy with maximum support during this very difficult adjustment process, even though the recession itself is over. It's pretty clear that supply shocks leave lasting damage on economies, and that's what the government's trying to address.
Mm, mm. So equity markets have run pretty hard post the downturn in March and April of this year. So, what's the outlook for 2021? And does a possible vaccine mean it's blue sky for investors and we're all off to the races again? Or what's your thinking there, Matt?
Well, I think the vaccine certainly is a game changer if the actual the actual results of the vaccine are similar to the trial. So, our expectation next year is the global economy can grow in the calendar year about 4.75%, so just under 5, and that's among the strongest we've seen
Yeah.
in the past 2 decades. And that's driven by partial economic reopening, the impact of the vaccine, and still sustained stimulus as well. And of course, with all the operational leverage we saw in the last US reporting season, where firms have worked their costs hard, they've increased their margins. A 5% growing economy plus inflation, which would make it about 6.5, I think then can very easily deliver 20% earnings growth. And so, I tend to think that The earnings are good. The challenge for markets, though, is valuation. So I wouldn't say it's blue skies for investors as much as it is necessarily for the economy. Because the challenge for investors is not only is is valuations, but it's also, well, how do you actually diversify risk? Because markets don't always necessarily recover in a straight line. Volatility is usually associated with that. So it's probably a bit of a bouncier time. And whilst we get 20% earnings growth, people may be surprised that we could get single-digit returns next year, despite that massive earnings surge. So the key not only is figuring out exactly how you can generate returns in this environment, but also how you can manage the risks, because there's still a lot of uncertainties about vaccine rollout. We do also have a negative quarter of growth in Europe in December this year, and in the US in March next year. So the recovery, and the inoculation programs won't really get going until the second half of next year. And so there's a lot of blue skies being priced in by markets, and people have got to understand that those expectations may not be met within those next 12 months.
Mm. So, given equity market and other risk asset valuations are considered high at the present, how can investors generate positive returns in equities and other risk markets?
Yeah, that's a great question. The returns we know that valuations are high. So at the moment, the US share market is trading at a 25 times PE ratio, which historically has been associated with a 2% per annum loss in the next 5 years. So people are sitting there thinking, okay, well, how can I actually generate returns? And this is one half of the investor's dilemma. And the way I'm thinking about it is I start looking at, okay, well, what sectors have done really well? And that is obviously tech. It's recorded a complete recovery. It's grown its earnings very substantially during that process. But the challenge for tech, of course, is is its valuation. So US tech shares, are trading around 50 times earnings for the mega caps. The rest of the market's at 15. So that's the US share market X the big mega cap tech stocks. And so how do I manage, how do I get returns? It really depends on what sort of risk premiums you're trying to extract. I try to think about the impact, or the combination of valuation, cycle, and momentum. So I think valuations are challenged most in tech. So I'm thinking about the other parts of the market. And of course, the parts of the market which have been left behind, at least so far in the recovery, has been the traditional value sectors, such as energy companies, financials, industrials, consumer discretionaries, and so on. And they're the sort of sectors which need higher nominal growth to actually grow their earnings. And I think they're going to get that next year. So when I look at the global markets, I'm looking for sectors with high leverage or high exposure or high sensitivity to economic growth, and also markets which have a higher exposure to those sorts of sectors. So it's the value sectors, as I said, and they have the highest weights in markets like Australia, the UK, Europe. And so I kind of look at those markets and think, well, they're trading a bit cheaper than the US, and I think they probably have more exposure to the cyclical upside. So that's where I'd be focused on, and putting my capital to work. Those sectors have lagged. I think they will have a catch-up trade. They're positively exposed to a steepening yield curve. So I think they've got quite a few things in their favour, and they're the ones which have generally struggled in the past 7 years. So I tend to think those value sectors are certainly going to have their year in the sun.
Yeah, so I guess my takeout from that is that potentially investors do not need to take on more risk. Um, However, they need to be more selective in opportunities.
Yeah,
And you made a comment around the return potentially of value stocks, and I think of emerging market equities. So, would you agree with that comment, Matt?
Yeah, well, the emerging markets not only are one of the cheaper markets, but it's also one which is exposed to the growth engine that is China. So in the MSCI World Emerging Market Index, about 70% of the index is from Asia. You know, they're obviously got good trade links with China. So I think that is definitely one area that we have looked at and we've increased our exposure to more recently. And at the same time, you know, just to reiterate the message to investors, it may not necessarily be the trend of the market that does well for them. It may be the trend within the market, and that's kind of how we're playing it at this stage.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
And possibly emphasises the importance to consider active management, I guess, there, Matt. If you've got to be more selective than being able to buy the whole market there. Um, Moving on to the balance or the allocation between Australian and global equities, Aussie equities had such a stellar run for from the early 1990s through till about probably 3 or 4 years ago, and then global equities have outperformed subsequently. So, what's your thinking around? Should investors now have a significant overweight to global equities in their portfolios?
Well, that tends to be the industry trend at the moment, you know, and I think there are some compelling risk premiums you can extract in global markets. But what I also tell investors in that we're in a lower returning world, and there's a lot less risk associated with dividends than there are necessarily earnings. So I think the ticks in the box, the reasons why you hold Australian equities in your portfolio is because it's a high dividend paying market. You know, the yields are kind of 5%, they're tax advantaged. And if you're looking to beat inflation by 5%, then you can do it in a lower risk way through the domestic equity market. Now, of course, the domestic equity market plays on miners and banks. You know, that's more than half the capitalisation there. So it's really getting a combination of risk exposures within your portfolio, not just in Australia, not just in global, but doing it in a combination, which I actually think can really help investors in what is going to be a lower return world. I don't think it's either or. So I tend to think each market has got benefits and you know and issues around it. Australia is no exception there to other regions. So it's really a combination of those two, which is really the key.
So perhaps moving now to the defensive sections of a portfolio, interest rates are now at historical lows and the outlook for returns from bonds is also fairly low. Um,
Mm.
so how should investors think about structuring their defensive portfolio allocations?
Yeah, that's a great question, and it's one which I think all fund managers are focused on. If you know, we look back in Australia, for example, for the last 100 years, the last 120 years, there's been 24 occasions when the Australian share market has recorded calendar year losses, and the Australian bond market has actually produced positive returns in 19 of those 24 years. So it has been a terrific and steadfast diversifier over that period of time. But, you know, and if you look back, for example, after 1980, so that's 40 years, the average return in bonds when Australian equity markets were negative in a calendar year was 14 or 15%. So it was very easy if you're thinking, oh, well, equities are coming off the
Yeah.
boil, they're expensive, they're volatile. It was so easy to buy bonds at that time because you could get double-digit returns in a riskless asset. You know, and we saw that in the GFC in 2008, Australian bond yields were around 7%, so it was easy to buy those. Today, they're less than one. And of course, bonds are less than 1% because of all the liquidity from the central bank asset purchase programs. That's distorted other markets such as gold, you know, the US dollars, you know, fairly elevated relative to its history, even though it is coming down more recently. So the question is, well, how do you actually diversify your risk there? Because your traditional diversifiers are very expensive, and so therefore just can't do the job that they have historically of the past. So, what the way we tend to do it in our real return fund, where we're trying to, give inflation plus 5% over rolling 5 years, but with low volatility, is that we have a whole bunch of diversifiers in the knowledge that each one of them won't diversify risk as well as they've done in the past. But if you have a collection of them, that actually can really help investors, manage what may be, significant volatility in the years ahead. So not only do we have government bonds in there and some US dollars, we do have some option protection, which is very important. We have some idiosyncratic trades, such as the Hong Kong dollar. So we think eventually China's going to break its peg. The Hong Kong's peg with the US dollar. They'll want their satellite city tied to the motherland rather than a strategic rival. So we got some options there, and of course, if when that peg is broken, there's going to be a massive rise in volatility. So, having options there helps manage the risk. And also has very significant upsides to it. Other things you do in portfolios, as well as those four things I've just mentioned. I do believe that having exposure to growth assets with cheaper valuations and better balance sheets, and stronger operating models, I do think that helps manage cycle risk. So there'd be more valuation risk, for example, in US tech than there is the US share market outside of tech. So we had those value and quality sectors in the portfolio. Gold downside probably isn't that large given all the central bank distortions. And the other way, of course, is by having lower than traditional exposures to equity market beta. That's another way of diversifying your risks. And you kind of want to do that when valuations are expensive, and they certainly are now. So you put all those 7 factors together, you still can get significant diversification in your portfolios, even though one of those diversifiers probably won't kind of produce the traditional offsetting returns that we're used to getting during periods of equity market volatility. And we saw that in September and October. So the US share market was down, nearly 10%. How did bonds do? Well, bonds sold off then. And that's a bit unusual. So investors have to realize that, bonds won't work as well as they have in the past. They will still offer some relative protection, but they need to be augmented with, several of those other trades which I've suggested. And that collective, force, I think, can diversify risk during periods of volatility. Even though valuations in those assets individually, are much more challenged than they have been in the past.
Yeah, you make some really interesting points there, Matt, and really thinking hard about trying to diversify that defensive portfolio allocation. And as you were talking and you mentioned US dollar, to me, it's rational, but I hadn't thought of it before as a potential allocation in a defensive portfolio, given that it always rallies when markets move into a risk-off environment. Yeah, so really interesting there. Um, Maybe moving back to equities and the valuations, what do you believe has driven equity market valuations to their current levels?
Oh, it's pretty much central bank liquidity. So
Mm,
the asset purchase programs, they exchange bonds for cash, and so a lot of cash then by banks is put to work, and it finds itself in asset, in risk markets. Because if you're selling a bond, you're not going to go and buy another bond. What you're going to buy is probably something with a bit more risk, and that was much easier this year, of course, because central banks had backstopped the credit market, so you could easily pick up a yield spread by buying, for example, investment grade securities or equities as a yield of last resort. But the equity market valuations themselves is solely a function of central bank liquidity, and really nothing else.
and I guess as equity market, multiples just continue to drive up, That's probably an outcome of exactly of that central bank liquidity and flooding the market with liquidity. And I guess you, for want of a better term, trumped me on my next question there, where I was going to ask about productivity gains and
Yep.
whether you see that as being a key driver behind valuations. Would I be right in saying potentially not at the moment, but going
No.
forward, it could
Yeah.
be extremely important?
Yeah, I don't think productivity is has any connection at this stage with the valuations in markets. But the key thing that central banks have done by doing QE, force bond yields lower, force equity valuations up, we have to keep in mind this: central banks do not create growth, and central banks do not create returns. All they do is pull them forward from the future, and what that means is returns henceforth in the next 10 years are going to be much, much lower. And, so at the moment, uh, our estimates based on valuations is the global share market will return around 4.5% per annum on average in the next 10 years. And people sit there and think and hear that and they say, oh, well, 4.5, that's not bad, considering bond yields are less than one. But, equity market returns are not going to be like a term deposit. They're not going to be the same every year. And if you have a look at a market, for example, like Japan, in the last 20 or 30 years, the last 20 years, it has delivered a 4.5% per annum average return. But within that, you've had 9 periods or where the market has lost 20% per annum or more. So low return doesn't mean low volatility. It actually means much higher volatility. And this can be really dangerous for investors such as retirees, who expose themselves to sequencing risk. And of course, they're much more exposed to falling markets, given the fact that they withdraw superannuation funds every year to fund their standard of living. So, it's a much more volatile world in front of us. It's a much lower return world in front of us. And it's pretty much the opposite of what investors had expected. Experienced in the last 4 decades. So, in relation to productivity, we also have to remember that productivity's really changed its nature. So I hear all the time policymakers and politicians saying, oh, we need to raise productivity. Productivity is not like it was in the 1980s and 1990s, where it was a case of, let's all share the bounty. If you guys work harder, I'll make more profits, I'll pay you more. And of course, the government collects tax. So it's win-win-win. So it's not now about sharing the bounty, it's about outsourcing the costs. So, the change in productivity's nature is very, very important because it's not the growth panacea that central banks and academics and politicians believe it is. And so, productivity is naturally declining through with technological advances becoming more asymptotic and, not delivering as much as they used to. And so really the way we need to be addressing the problems we have in the world of high leverage, high valuations, higher unemployment is simply through higher nominal growth. And whilst productivity sounds convenient to drive that, I actually don't think it will be.
So, corporate earnings growth has been strong in certain industries and sectors. So,
Yep.
can earnings growth match the performance of the last economic cycle?
Yeah, well, you certainly hope so, because when you look at markets like Australia, the UK, and Europe, their earnings for the last 10 years only grew 20% per annum in total. So it was incredibly anemic growth. And the only market where you had a significant growth in earnings, of course, was the US with its tech exposure. And so earnings there grew around 17% per annum, if I remember correctly, per annum for the last 10 years. And of course, tech firms grow earnings virtually by stealing market share and being more cost efficient. And I think as these firms get bigger and bigger, it's going to just be harder to steal that market share more and more. I think there's also going to be regulatory issues around those tech firms. There's a risk of breakup, a risk of regulatory tightenings of their operations and so on. So I think they're probably going to face a tougher decade, and hopefully that might free the space up for the for other sectors to grow their earnings. But I do believe we're in a lower nominal growth world. And despite the fact that central banks and consensus tells that growth's going to materially improve each year, it's been falling structurally now for the best part of 25 years. And I don't see why that would be any different in the next 5 years. So, lower earnings mean you have to be a little bit more nimble to be able to extract out where earnings growth is underpriced by the market, nimble in your portfolio composition. And moving away from the benchmarks also helpful on that front, because what it means is that you don't have to necessarily have a set strategic asset allocation to certain risk markets. Better portfolios for this sort of world are those which don't have strategic asset allocation frameworks, and actually portfolios are simply built from the bottom up, and full of sectors and markets and asset classes which can help investors beat inflation by 5% or more. I think that's a sort of portfolio construction which is going to be particularly useful for investors in the next decade and beyond.
So, Matt, what's your outlook now for the Australian economy? And I am very interested in your thoughts around the risks with China. China certainly appears to have a policy to just slowly broaden the bans on Australian imports. I think we've seen beef hit overnight again.
Yep.
So, where do you think this will end?
Oh, look, there's no doubt that China is tightening the screws on Australia. And, obviously, China has been a tremendous source of growth and wealth creation for all Australians in the past 20 years. Um, uh, and as a result, our industry policy hasn't been, particularly dynamic. A large portion of our exports, namely coal and iron ore, to 4 countries, namely China, Japan, South Korea, and India, is more than half of our export base. So Australian industry policy has been actually fairly lackluster, and certainly we've been living through the great complacency in this country about our economic policy. So I think Australia in the next couple of years is going to do particularly well. So I'm expecting real GDP growth in Australia of 4% per annum for each of the next 2 years. So I think we'll be doing particularly well on that front. We had a fairly solid bounce in the September quarter national accounts, despite the fact that Victoria was closed for a large portion of that, and despite the fact the household savings rate didn't really come down much. So not only do we have large-scale policy support from the RBA and also from the Morrison government, but household savings rate in Australia is now 19% of disposable income. In
Wow.
February, it was
Yeah.
4. So that to me tells me that Australia is going to be doing pretty well in the next couple of the next couple of years, despite the fact that China is going to be making exports harder. And so it's very difficult, though, for them to materially decline our iron ore exports, because Australia is a very large producer of global iron ore, which we send out via ships, and China buys 70% of global seaborne iron ore. Brazil is really our only strategic competitor there. But even then, iron ore in Australia is a huge source of export income. Challenges come, of course, with other areas, particularly services like tourism and education. That's where they can tighten the screws, and they're making life difficult for the wine, for lobsters, for beef, as you said, Paul. But what Australia has to do is look for different export markets. And, I think that would be very sensible, very sensible from a portfolio perspective, to not just have one buyer of your exports, but actually have 5 to 10 significant buyers. That, of course, decreases your risk of kind of geopolitical issues hitting your economic policy. But that said, even if China imports less of our goods, that should just mean an exchange rate depreciation. But the challenge for Australia at the moment is our exchange rate's heading the other way as China, is tightening the economic screws on us. So, hopefully different export markets can be found. And if that's the case, it's probably going to be to Australia's benefit that we diversify away from China, particularly towards India, which is also an emerging market, which is going to have a bigger population. They're English speaking. They have respect for rule of law. They're not there stealing intellectual property. And of course, they have the benefit of having a very young population, and I think there's a lot of camaraderie and respect between India and Australia. So I think that's the market that Australia probably should be targeting, that in Indonesia, given they're literally our next door neighbour.
It certainly makes sense, your comments there, that further deepening the relationship with India there, of which we have a fairly close relationship, perhaps not on the cricket field at times, but elsewhere. But that's a pretty positive outlook for the Australian economy. I guess in the back of my mind, as you were talking about 4% plus GDP growth over the next couple of years, I'm like, oh goodness, residential housing,
Mm.
with the savings rate up and the growth coming in, we'll probably see the continued growth in residential property then.
I think there's very little doubt about that. We've already started to see prices move. Housing activity's picking up. Australians love housing and property. They do well at it. And interest rates are at historic lows. So it's pretty hard to see a combination of low rates, strong growth, and falling unemployment, being bad for property. So I suspect housing activity is certainly going to increase and add to growth, and add to household wealth in the next few years.
So maybe just drawing the podcast to a conclusion, what do you think are the three key risks markets are not factoring in? And is an inflationary spike over the short to medium term a potential concern for investors, Matt?
Well, it's certainly, I think that's one of the things that markets probably not pricing in. Now, I'm not particularly concerned about inflation at this stage because of all of the excess capacity that is in both the Australian and the global economy, with unemployment close to 10% or the shadow unemployment rate close to 10% in both the US and in Australia, and also in Europe. So any inflation spike, I think, would be a real negative for markets and for the economy. So that's probably one risk that is not being properly priced at the moment, even though I still think the risk is fairly minor. Probably the biggest thing I think of next year is vaccine setbacks. Markets are very aggressively priced for a seamless rollout of vaccines from Pfizer, from Moderna, and from AstraZeneca. And by my calculations, it's still going to take us 18 months for global herd immunity to be achieved. And so that means some parts of the global economy are going to have to go through another COVID winter, which can lead to economic closures, etc. And I tend to think the world's become far too complacent about this, including financial markets. So complacency and shocks leads to setbacks for markets. So that any problem with the vaccine from a health perspective means that less and less people would have it. And that's something markets aren't priced for. The other thing I think, which is an issue which markets aren't focusing on, is really policy error. I think at some stage in the next year, central banks will begin to wind back the asset purchases. We saw in 2013 when Ben Bernanke said, I'm reducing monthly purchases from 85 billion to 75 billion, which is an incredibly minor reduction. Equity markets really became very volatile for several months, and there were some large losses there. So I tend to think monetary and fiscal pullback at some stage next year could be a source of market volatility. And that's why we still have considerable diversification in the real return fund, because economies and policies don't always go in the same direction. And as such, policy mistakes or changes in policy don't have to be mistakes. That can spark higher market volatility. And with valuations where they are at, markets could have a very sharp adverse price effect if those risks actually become central case.
Matt, thank you very much for joining us on the investment podcast series. I've certainly enjoyed the conversation and found your insights quite fascinating. And I guess I must admit, to disclaim it outright, I always enjoy the discussions with people that work on diversified portfolios, because you have to make those decisions between allocating between the various asset classes, which naturally means it forces you to have a view on the
Mhm.
various asset classes and within the asset class. So again, thank you very much. I'm sure the listeners have very much enjoyed your insights, Matt.
Thanks very much, Paul. It's been a pleasure to be with you. I just wish you and all your investors, a happy new year. And let's hope 2021 will be better than this year.
Yeah, very good point there. To the listeners, I hope you have a great rest of the day, and all the best to you and your families for a safe Christmas and a merry New Year. And let's hope 2021 is a little bit more positive than what we've gone through in 2020.
Thanks for listening to this episode of the NetWealth Portfolio Construction podcast series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.